Let me stay on the topic of global investment, where geographic boundaries seem to be increasingly irrelevant. We're joined now on the phone by Laurence Schreiber, co-president of investment management firm Clarity Capital. Mr. Schreiber.
Hi, Benjamin.
Thanks for joining us. So, with constantly improving global communications and information flow, it seems like investing has become a global endeavor. Do geographic boundaries still matter?
That's an interesting question, Benjamin. Globalization has been a term that's increasingly been used in the investment world in the last 15 years, certainly in the last 10 or 5 years. And there are examples where I would argue markets truly are global and regional boundaries, geographic boundaries don't matter as much. Two examples. One would be global companies. When you look at a company, for example, like Apple today, they are a U.S. company, but their fastest growth is coming out of China in the last quarter. And they are held by investors around the world. They have sales around the world. They're a brand around the world. I honestly don't think they are operating with much of a constraint based on geography. Oh. And a second category would be industries. Oil and gas, for example, or gold are global industries because the commodities themselves are trading around the world. And I think an oil company in Northern Europe and an oil company in Western Texas are more affected by the price of oil than by anything happening in their own regional area.
Well, being that you're looking at it on a case-by-case basis, it seems. I mean, what are the factors that are preventing further globalization?
The major barrier, I would say, to prevent further transparency and flows of cash is government intervention. By that I mean legal impediments governments impose, regulations, taxes, tariffs, trade restrictions. Governments continue to put artificial barriers in place, which lead increasingly to a lack of transparency and a lack of ability for capital to flow to the most effective and efficient areas. One example of that recently was the United States, where foreign companies, non-U.S. companies in Europe and in Canada were acquiring U.S. companies because the non-U.S. companies had a lower tax base. By acquiring the U.S. companies, they could combine the entities and lower the tax rate.
Right.
The U.S. government imposed massive restrictions on these so-called tax inversions and prevented the flow of capital. So you're creating a regional issue where U.S. companies won't trade at the most efficient prices.
Okay, this is clearly a very complicated story. Well, Mr. Laurence Schreiber, co-president of Clarity Capital, thanks so much for joining us.
My pleasure. Happy to be here.
Thank you.